Thursday, October 13th, 2022, Monaco 64, home of alternative economics and contrarian views. So today's title, as you've seen, is UK economic collapse is underway, part 3. Why part 3? Well, I keep a lot of playlists, and I recommend you go onto my playlist. There's a lot of topics that I think are very interesting and very pertinent for the monetary system, for the economy, and you can go and listen to many of the videos I've done in the last 5-6 years about all those topics. But I created a playlist for the UK economic collapse 2021-2022. Yes, I'm not just saying this now because everyone's saying it. I've been warning about this since July 2021, and I've even warned in July 2021 that it was not an energy crisis that we were experiencing, but a currency crisis, a currency collapse. And I think I've been proven right, especially as it pertains to the pound and to the euro. So this is what we're going to look at today, part 3, and I'm going to focus on the mortgage market, property or real estate in the UK. And I've said in the past that when you are at the end of the road in terms of a fiat currency, you get crises coming from left and right. You think you've solved one crisis, and then another one pops up. So that's what we're going to look at today. Before I start, though, I'd like to cover a few topics that I think were important that came out yesterday. The first one is to do with Janet Yellen, who was the chairwoman or chair, whatever you want to call it, of the Federal Reserve, and is now the Treasury Secretary of the Treasury. A couple of days ago, October 11th, this is the quote she made, and I got this from Breaking Market News on Twitter. U.S. Treasury Secretary Yellen: "I'm not seeing anything in markets that causes me to be concerned." And I even wrote something on my retweet. I said, "This statement should be of great concern in my humble opinion." Lo and behold, a day later or yesterday, Yellen said this, and this is from Bloomberg News. Yellen worries over loss of adequate liquidity in treasuries. Treasury Secretary notes surge in supply of treasuries. Yellen flags that Fed's standing repo facility could help. So now the U.S. Treasury is telling what the Fed needs to do. Well, not surprising. And why is there a surge in supply of treasuries? Well, because the Treasury has been spending like a drunken sailor, so it has to borrow more money through issuing treasuries. It's not rocket science. And she talks about this as if it was something that she can't help, or, oh, it's come out of the blue. We got loads of supplies of treasuries, right? But let's quickly go through this article. It's not a long one. It says Treasury Secretary Yellen cited concerns about the potential for a breakdown in trading of U.S. treasuries as her department leads an effort to shore up that critical market. Yeah, so critical, isn't it? Safe haven, just like gilts. This is what she said. "We are worried about a loss of adequate liquidity in the market." Well, no one wants to buy this anymore. The global south, Russia, China, India, Brazil, they probably don't want to buy as many treasuries. The Fed is not buying treasuries. So it says Yellen said Wednesday in answering questions following a speech in Washington, the balance sheet capacity of broker-dealers to engage in treasury market making hasn't expanded much. Yeah, no, I don't want to say the word, but you know what I mean. While the overall supply of treasuries has rocketed or climbed, as she noted. Maybe she'll be the next candidate for a Nobel Prize in economics, like her predecessor, Ben Shalom Bernanke. Treasury debt outstanding has climbed by about $7 trillion since the end of 2019, but big financial institutions haven't been as willing to serve as market makers, burdened by the so-called supplementary leverage ratio, or SLR, which requires that capital be put up against such activity as well as against reserve holdings. Yellen noted that the Federal Reserve now has a standing repurchase facility to provide liquidity backstop to Treasury market that can be helpful, she said. She also said the so-called Group of 30 panel has presented some good ideas on reforms that would help strengthen the market, including the possible expansion of central clearing. While they've had this problem since, I would say, March 2020, the liquidity in the market, that was one of the reasons they had to increase QE by a massive amount. And I think it's going to happen again. So now to the Bank of England. What happened yesterday? Well, my video yesterday said how they had backtracked. And they had up until that particular time in the morning. The FT maybe was trying to like play with things. But then they came out after they made my video and they said, no, the FT is wrong. We're going to stop the QE tomorrow, 14th of October. So yes, you've got 3 days to do whatever you want. So the markets got nervous again. The gilt market dropped again massively. Yields rose like 20 or 30 basis points. The 30-year went up to the previous high we'd seen at the beginning of the crisis, around 513. But then at the end of the day, they came in and actually bought 4.4 billion of gilts. So that calmed down the markets, but I don't think we're out of the woods yet. So those are the two topics I wanted to mention before we go on to UK economic collapse part 3. And yeah, it doesn't make me happy to talk about this because I live in the UK and I don't want to see our economy collapse. But unfortunately, there is no other way mathematically because we've been living beyond our means. It's not just since the mini budget. It's not since the war in the Ukraine. As you will see by my playlist, I started warning about this in July 2021. The energy crisis started last summer. In the summer of 2021, energy prices were already going up. Inflation was already picking up. What happened in the Ukraine from February was just an exacerbation of the crisis. So people who say that the war in the Ukraine is to blame for everything, they're not being really truthful. And I've been warning about this for years, of course. And some have been warning for decades. And it is decades. It's the philosophy that the state can keep bailing everyone out all the time, businesses, the public, yes, even foreign entities like we're doing now. And there comes a time when people realize that it will never stop and they try to run away from the currency. And that's where I think we're now. And as I said earlier, is the kind of environment that when you solve one crisis, another one pops up. It's like never ending. So I think last year, 2021, we saw a lot of commodities rise. Do you remember lumber, beginning of 2021? And then we started seeing natural gas, oil, energy rising way before Ukraine. And we started seeing the measures of prices rise, CPI or RPI in the UK as well. And I said, this is going to result in higher mortgage rates. There's a lot of people that have to renew 2-year deals coming up already in 2023. Because in 2021, interest rates got down massively because they did a lot of QE after 2020. And yes, Rates were almost at zero. Even the 10-year gilt yield was below 1%. The 2-year gilt yield was below near zero, and that's what they priced mortgages off. So people took a lot of debt. They had some savings because they got paid to stay at home doing nothing. They couldn't spend it, so they bought properties. They thought interest rates would never go up, but now they are. And so we had the energy crisis. That's not over yet. Yes, they've kind of dealt with it. They thrown this 150 billion pound package at it. Yes, it could be less if energy prices come down. It could be a lot more open-ended. Now they're trying to solve this final salary defined benefit pension crisis with the Bank of England intervening. Yes, they're going to stop tomorrow, but I bet you if the gilt market, let's say next week, drops out of bed again, yeah, I think they'll come back with more QE. So that's why they're never going to stop. They can't stop. And now we've got the mortgage crisis. And I've got some anecdotal evidence here and some important people in the scheme of things warning about it. One of them is Martin Lewis, who I don't really follow, but he's very popular with a lot of people. He helps people. He's got a money saving supermarket or something. He helps people in the UK save on their bills. I'm not sure he talks about the the real purpose of saving money, but he helps people save money on different things that they spend and how to go about it. And to be honest, I never followed him, and he's very popular. So I saw this article. I think it was actually this comment from him came out, I think recently, maybe late last week or earlier this week. So this is from HuffingtonPost.co.uk. Martin Lewis calls for mortgage emergency plan to defuse ticking time bomb. So yes, we had a package for energy. Now this guy wants a package for mortgages. I think that would be even. I mean, that's just crazy, isn't it? More and more, because all it would mean a mortgage emergency plan is more money printing. Because how do you think government can solve that problem? Well, only through borrowing and the Bank of England printing money, because who's going to be buying those gilts? So let's go through this. Money saving expert founder urges government and Bank of England to act now to avoid a full-blown bailout later. So he might be good at helping people save money on their mortgage deals or energy deals, but maybe he should have told people not to get into so much debt in the first place and put aside some money to buy a little bit of gold and silver on the side, to be protected, to pay off debt. I don't know. I don't follow him that much. Anyway, let's go through this, the gist of it. Martin Lewis has called for the creation of a mortgage emergency plan as fears grow over spiraling interest rates about to hit households during a cost of living crisis. Well, it's a currency crisis. It's happening because we've had decades of deficit spending, money printing, artificially low interest rates, and now the tide's turning, interest rates are going up, investors want their pound of flesh, if you want to call it that. Speaking earlier on Monday on ITV's Good Morning Britain, yeah, it was on Monday, the consumer champion who was answering viewers' questions said a full-blown bailout next year could be avoided if a plan was implemented by Christmas. The journalist warned, we'll have to throw money at it. Well, whose money? There is no money, Mr. Lewis. And the thing that this would do, if they follow his advice, it would punish savers again. as was the case with energy bills when warnings weren't heeded in time. So as I said, he wants the same kind of deal for mortgages that we gave for the energy sector. It comes as average 2 and 5 year fixed mortgage rates are continuing to climb above 6%, according to an analysis after many deals disappeared from the market amid the fallout from the recent mini budget. They're blaming the mini budget. I'm blaming decades of profligacy, actually. Lewis said, if you're watching, regulator, Bank of England, government, you need a mortgage emergency plan now, or there's a ticking time bomb. That's my opinion. Last week, MoneyFacts calculated that based on Thursday's rates, someone with a £200,000 mortgage, paying it back over 25 years, could end up paying around £5,000 per year more for 2.5 year fixed rate deal than they would have done last December. I'm going to stop here, but you get the gist of what he's trying to say. I'll put the link to the story below in the description, and you can read through it to see how rates are shooting up. And to be honest, I don't like to wish people misery, but in the last few years, speak to friends, colleagues, and people you meet about housing. I always used to hear a lot, well, interest rates will never go up to 6%. They're going to stay very low. And people never thought that this could happen, and now it's happening. So, and there's another article here that shows how housing and the mortgage market are about to implode, if not imploding already. And this is a really interesting one because it's something that's happening that hasn't happened probably in 25 years or not even before. It's from the Telegraph from yesterday. It says home buyers lose deposits after lenders pull mortgages. Lenders reneging on offers late in the process because of interest rate panic. So again, I'm going to put a link to this article because I don't want to drag on with this video for too long. And it will be under archive.ph. So if you don't pay for the Telegraph subscription, you'll be able to read it. But just give you an example here. An estate agent from a London agency called Benham and Reeves said that banks were even U-turning on offers after contracts between buyer and seller had been exchanged. And he said, in my 25 years, I have never seen a lender pull a mortgage offer, but we have heard of at least 10 cases. To go back on a firm mortgage offer is pretty awful and very stressful for everyone involved. And you might think, oh, it was a deposit. It might be just 10% of the deposit that they lose. But no, I think people probably have lost a lot of money, and you got to be really careful. I think if you've got a deposit and you want to buy a property, you could lose the whole thing if they pull the offer. Look at this one here. In one instance, a buyer purchasing a property worth just under $3 million in London had secured a mortgage offer at 2.2% with a 35% deposit. So just over £1 million deposit. Mr. Von Grunhair said, he's the estate agent for that agency, the property was off plan and he had already exchanged and paid the deposit. So he paid $1 million, over $1 million. Then just under 2 weeks ago, the lender, who is a major high street name, pulled the offer and hiked the rate to 4.8%. It has more than doubled the financing costs, and the buyer could lose their deposit and be sued by the seller for legal costs. So I think it's unraveling. Yes, this is the high end, but it could happen to any kind of level of price. So, and next year, of course, as well, all those people who took big mortgages or loaded up with debt in 2021 when rates were really low. They're going to have a problem refinancing it. And now, of course, Martin Lewis wants a package to help this crisis out. And why is this crisis? Why has this accelerated, exacerbated? Why have rates gone up so much? Well, yeah, the mini budget might have triggered it, but before the mini budget, they announced this open-ended energy package, which I think is what got it started as well, got interest rates going. So yes, you save people £3,000, maybe £2,000 on their energy a year, but now you're costing them multiples more in their mortgage refinancing. It's crazy. So let's hope the government, the Bank of England, the regulators don't listen to Martin Lewis, but unfortunately, my feeling is that they might. There's governments and central banks always seem to want to keep things going. And yes, and who suffers with that? Well, people who hold pounds, people who actually don't have much debt and have saved, who are also on a fixed income, they're going to suffer because they're going to dilute the currency even more. And that's the definition of a currency collapse or inflation. So with that, let's quickly look at where the markets are this morning. It's 8:40 a.m. London time. We got spot gold at 1669. It's down about $4. High's been 75, low's been 67. Silver's down 6 cents at 1894. High's been 1911 and low 1891. Silver, yeah, this price is very frustrating, the paper price. But I've been listening to people like Rafi Faber. He was on Arcadia Economics, I think yesterday, saying how COMEX and all the major silver ETFs, a lot of the physical silver has been drained. There's never been so much drainage of physical silver, and the premiums keep going up. And he thinks all the silver from COMEX and SLV is flowing into the retail sector because the premium's so high. So people not stupid. They take delivery on those exchanges where the prices are manipulated, and they sell it to the stackers. The stackers are paying probably the real price. So I think we need more patience. And with all that's happening that you've listened to me talk about, I think it's more important than ever to have a little bit of gold and silver. Is it going to make you rich? It could, if you get involved in the mining sector, or even if we have a major collapse of the currencies and nobody accepts them anymore, gold and silver will go a long way. It's not like a trade. I've never said it was a trade. And that's why I've been stocking since 2002. And it's like saving for a rainy day and saving in money that holds its value over time. So the stock market, the Dow future is up 83 points. NASDAQ 100 future is up 11. S&P is up 9. So fairly quiet, the markets. FTSE is down 32 points, just below 6,800. To the currencies, we got sterling down slightly at 110.89. The euro is down slightly as well at 97.00. The dollar is down about 0.1% versus the yen at 146.80. The dollar is up an eighth of a percent versus the Swiss franc. It's almost at parity, so at 99.90. And the dollar yuan is up 0.25% at 719.30. Yeah, it looks like the dollar is strong versus the Swiss franc, almost at parity. I think it was trading like at 92 some months ago, or 95. But I remember when the dollar was like 3 francs back in the 70s and 80s, 2 francs. So it's all relative, really. To the other currencies, Aussie dollar unchanged, 62.77. Dollar is unchanged versus the Canadian, 138.14. Kiwi dollar unchanged as well. So it looks like the currencies are very steady this morning. Not much going on. We've got, of course, CPI today in the US. That will be an important number. To the commodities, WTI crude up 0.4%, 86.70. Brent crude up 0.6 at 92.30. High grade copper down slightly at 341. US nat gas up 1.8% at 673. Check the Dutch TTF nat gas futures. That's up 4% at 166. And to finish off, quickly look at the bond markets. The gilt market, the 30-year yield, yes, it came off at the end of the day yesterday because they came in with the QE, 4 billion it was. Right now, the 30-year is down another 7.5 basis points at 482. And the 2-year yield is just around 4%. So, yeah, it's probably going to continue to drop today and tomorrow, the gilt yields. But what will be interesting is once the support is removed tomorrow, what will happen after that? U.S. Treasury market, the 10-year yield is up about 3 basis points at 393. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.